Hey everybody, December 13th, back for another edition of That's Our Two Satoshis Live. For those joining us for the first time, a couple things. One is we generally review what's going on with the week in digital assets and generally follow the outline of what we wrote yet last night on our blog at ar.ca/blog. You can see the written version of That's Our Two Satoshis. Usually joined by one of my esteemed colleagues here at Arca, but today I'm going to go at it alone. So let's talk about what we are seeing in the market. So first and foremost, not a fun tape right now, right? Everything's going lower. A crab market for Bitcoin and Ethereum, right? It's crabbing up and down. I think some of the other assets around digital assets faring much worse, pretty much just straight down. But let's back up for a second, right? Let's get to the macro and figure out what's happening here. This looked like an easy macro trade 4 weeks ago. All of a sudden, you had two things pop up. You had higher inflation, and you had the Omicron variant that every risk asset was freaking out about. You saw just about everything that you'd expect happen 4 weeks ago when you have a risk-off environment. You saw gold rising. You saw interest rates going down. You saw the dollar going up, equities going down, etc. What is interesting, though, is 4 weeks later, everything has retraced except for digital assets. So the Treasury curve is basically right back to where it was. The equity markets, S&P and Nasdaq, right back where they were. The VIX, which had risen from 16 to 35, all the way back down to 19 as I'm talking right now, or at 20. You name it, oil came right back. So pretty much everything that we look at from a macro standpoint has rallied right back. And why is that? It's because, even though the inflation print is high, it's not crazy and out of control. We're also heading into tougher comps next year, which the market is basically aware of. If you look at something called the five-year break even, it basically tells you what the market is anticipating inflation to look like a few years out, and that's 2.6%. So it doesn't matter that the CPI came in at 6.8%. The market is telling you that that's just an aberration, and it's going to go back down to what everyone expects, which is a normal 2 to 3%. So why has every other risk asset gone right back to where we were a month ago, but digital assets are still falling? And this is tough, right? I mean, you can go back to Paul Tudor Jones's thesis about 18 months ago about inflation, right? And if you actually remember, it had nothing to do with just Bitcoin. It had to do with all the different ways that he was playing for an inflation trade. He was buying gold. He was buying yield curve steepeners. He was buying the Nasdaq, and he was buying Bitcoin. Only two of those four worked, right? Gold has been a disaster. The yield curve trade has been a disaster. But the Nasdaq is up 86% over the last 18 months, and the Bitcoin is up 467%. So it's not just about identifying what the idea is; it's about how do you actually execute that. And I think what we're learning here in the last few weeks here is that digital assets are not the same as every other risk asset. You could even look at the breadth of the equity market and say the same thing. While the S&P and Nasdaq have largely clawed all the way back, it's been driven by a couple of big names. Your largest tech names like Apple and Google and everything else. But there's been real carnage out there with recent IPOs and SPACs and anything that Kathy Wood and the ARK Invest Fund owns. You've seen real carnage in meme coins like AMC and GameStop. So all this is related to digital assets, right? Digital assets for most of the last 18 months, we started to see real sector dispersion, right? DeFi trades very differently than Bitcoin, which trades very differently than ETH and NFTs and gaming and Web3. All that has been true up until the last few days. The last, call it since December 4th, that dispersion is gone. We're seeing a real student body left, student body right environment right now where, for every, one or two outliers like a Luna or an Avalanche that has performed better than others, most of the market has just been straight down. And this likely can't continue. It can't continue this way, right? This asset class has evolved way too much over the last 18 months for this to sink right back into a 2018 like broad-based bear market. 4 weeks ago we started to wonder if the risk factors that we were seeing in the market were going to be more parallel to March 2020, or if it was going to be more of a parallel to May 2021. And what I mean by that is, if you go back to March 2020, it started very similar to what we saw a few weeks ago. Everybody was dismissing COVID. Oil really started to break down. There was real weakness in the overall equity markets, and the VIX was starting to rise. That's what we were seeing 4 weeks ago. You fast forward to today, and almost every part of that is gone, right? We now know what Omicron really is. Like I said, the equity market has bounced back. The VIX has bounced back. There hasn't been any real sliding in commodities. It doesn't feel like an Armageddon scenario. So that puts us back into May, June 2021 department. So what happened then? It started with a big leveraged liquidation, just like we saw a couple weeks ago. And then it accelerated as people started just getting fearful, and you started to see a huge move in the crypto fear and greed index. Falling as high in the 80s and 90s in April, down to in the teens and 20s in May and June. And you started seeing people coming up with all sorts of conspiracy theories as to why the market was going to be a multi-year bear market. People were talking to China exiting the market and regulation becoming too draconian, and a Celsius blow up or a BlockFi blow up. All these excuses and fears were starting to percolate the market. But when you actually pulled the onion back, there wasn't a whole lot of substance there. In fact, if you go back to June of 2021, we actually, on this same very blog, on the Arca blog, we wrote debunking all 10 of the bear theses in the digital asset market. And I think 9 of the 10 things we debunked ended up coming true. So does that mean that's where we are today? Well, the hard part about today is that I don't even understand what the bear thesis is. We've heard everything from it's because of tax selling. Well, that doesn't make a whole lot of sense, because nobody's paying their taxes in December. You have to wait till March or April to pay your taxes. We've heard things like VCs are being forced to redeem because of their LPs demanding to be paid out. Again, maybe, but where does that money go once they get it? They're just going to pour it right back into the digital asset market, right? It's not like they're going to the bond market or going to equities. So it's just really hard to figure out where this selling pressure has come from, other than this is what happens once in a while when digital assets get overheated. Is you have a real reason for a sell off, like a liquidation, and then people start to change their sentiment and start shorting it. And I think that's what we're seeing right now, because there really has been a tremendous amount of cash built up in the system, ready to buy as soon as the waters are clear. Market makers are telling us and others that it's been pretty orderly. It's not like panic selling. It's really just seems, again, like a buyer's strike. We posted a chart in the write up this week about what happened in the last 2 weeks of the year for the last 4 years, and it's actually kind of interesting because if you go back to 2018, for example, we had about 5 months of a down market towards the second half of 2018, and it basically stopped around the midway point in December, and we had a pretty bullish setup from there on out. 2019, same thing, right? First half of 2019 was great. Second half of 2019 was pretty awful. Right around mid-December, that's when the cavalry arrived, and you started seeing people calling for $80 ETH was the bottom. It's not going below that, and same thing. We had a pretty bullish last 2 weeks of December, and then off to the races in the first part of 2020. And even last year, a little bit of a different setup last year, because we had a pretty big bull market already starting in September, October, November. But same thing. First 2 weeks of December were pretty ugly. People started to call the top, and then what happened? We completely took off in the last 2 weeks of December and into the first 4 months of 2021. So we'll see if history repeats itself. It's Monday, December 13th, as I'm saying this. So we'll see what the last couple of weeks of December look like. But at least as it stands today, this seems like an overreaction and an overcorrection to a macro backdrop that, quite frankly, isn't playing out the way people thought. Okay, elsewhere, moving on from the market and looking at some other stories that are happening here. I think the big one for us was looking at the large Badger DAO hack that happened last week or 2 weeks ago, where um, I believe $120 million was stolen from people using the Badger DAO. But it wasn't covered by Nexus Mutual, one of the largest insurance providers of DeFi, with over $700 million of active coverage. And the reason was actually pretty straightforward. It's believed that the hack was unauthorized withdrawal of user funds, and actually at the front end, not through the protocol itself, which basically means that according to Nexus Mutual's rules, they cover hacks at the protocol level, not user error. So the question is, well, where do we go from here then, right? This, from a Nexus standpoint, seems pretty straightforward. The policy clearly stated it's not covered. An event happened, it's not covered, you can move on. But from a more broad standpoint, the question is, well, how do we get more usage of DeFi if people don't know how to protect themselves, or quite frankly, can't protect themselves, right? It's not that people are purposely getting tricked on the front end by bad actors. It's that most people don't really know how to audit a code and don't really know how to protect themselves. There's a reason that fire insurance, doesn't cover a 5-year-old playing with matches in your house. There's a reason that, auto insurance, doesn't cover if somebody steals your keys and drives away with your car. There's only so many different ways you can protect user error. So what do we do about DeFi? That's a big question that I have going into 2022. Is if I'm a protocol, if I'm Uniswap or Sushi or Aave or Compound, I'm doing everything I can to encourage my users to go out there and get protection. I'm even selling Nexus Mutual Insurance on behalf of my customers, saying, "Go ahead and get this. You want to protect yourself. We want you to use our protocol safely, rather than leave it up for chance." So I think that's a big story heading into 2022. Is we want more adoption, we want more usage, but you can't just blindly send people to the wolves who don't know what they're doing. And there has to be some sort of solution between going out and buying insurance on your own versus it being sold to you directly at the point of attack when you're using the protocol. I often think about it as when you go to rent a car. If someone told me, "Here, go rent a car and then go drive for 30 minutes and then call me and go buy insurance," nobody would do it, right? But if they sell you the insurance at the point of attack when you actually rent the car, you're more likely to do it. I think that's where we have to head in terms of DeFi. It's very unlikely that people are going to go use Compound and then separately go to Nexus Mutual and buy insurance. Compound has to start taking the onus upon themselves to say, if you're going to use our protocol and we want you to, here's a way to insure yourself. So looking forward to seeing more things happen in 2022 and beyond when it comes to insurance. And then finally, I'd encourage people to go read this themselves. But I thought it was pretty interesting looking at the backlash that OpenSea's new CFO, Brian Roberts, got from just coming over from Lyft and basically saying, we're going to do an IPO. Huge backlash from the community. Everybody was like, why would you do an IPO and basically just enrich the early venture investors who put a little bit of money into OpenSea and not reward the tens of thousands or millions of users that are now using OpenSea every day with a token, right? OpenSea has done 10 billion of lifetime sales with almost a million users, I think, to date. That's a lot of people to leave out in the cold if you end up doing an IPO. So what was interesting is immediately both Brian Roberts, the new CFO, as well as OpenSea, completely backed down from this potential IPO. They immediately backtracked and said, "Okay, we were just discussing it. We're not really going to do it." This is a big trend heading into next year. Is that this idea of just putting a little bit of money in as a VC to a project and expecting to take 100x or 500x out in the equity market seems like that's going to be a tougher pill to swallow as these communities start to rally and organize more and expect to be paid back for the efforts that they've put in. Right? We actually wrote exactly a year ago in December of 2020. We wrote an article talking about Airbnb and DoorDash, right? Why should we be excited about an Airbnb IPO when all of the people who own houses and vacation and made Airbnb what they are got nothing, right? Why should we be excited about a DoorDash IPO when all the people who eat food and cook food and ride bikes to deliver food got nothing, but the early equity investors made a fortune? We'll see. I think the trend is definitely moving in the direction of the communities who make these projects and companies work demand being paid back for their efforts, and it'll be exciting to see how that is actually pulled off as we move forward. But I think the bigger overarching lesson from all this is that these companies, governments, finance institutions, banks, etc., they are all severely underestimating how much everybody hates them. Right? The world is fed up with these oligarchs taking all of the money from everyone else. I see it every day in myself. I dedicated my career to digital assets 5 years ago, but I came from the traditional finance world. I have, the CFA letters in my Twitter bio. I have, the fact that I worked at Lehman Brothers on my LinkedIn profile. I get destroyed every week by someone on Twitter basically calling me out for being an old school TradFi guy and not being able to relate to people in digital assets. So if that much hate and anger is, pointed towards someone like me who left Wall Street to come specifically to digital assets, imagine what kind of hate and change is going to be forced upon these other traditional veterans. I mean, you can see it last week with Constitution DAO as well. There were 17,000 unique Ethereum addresses who put in $45 million to fund the bid for the copy of the Constitution. And one billionaire, Ken Griffin from Citadel, decided to come over the top and buy it himself. You couldn't ask for a more tone deaf response, right? A billionaire basically trumping 17,000 people who wanted to do something. So, we're seeing it every day. We're seeing it in our seats professionally. We're seeing it in our seats, just personally, that the world is changing. What we thought the world looked like 10, 20 years ago with, just the top 10% of the wealthiest Americans owning all the stocks, that's going to change in a big way, courtesy of digital assets. And we're pretty excited to see it. So we put some interesting links in the article this week. We encourage everybody to go look at it. I think this is our last write up of the year. So appreciate everybody who's come with us on the journey. We'll be out with our 2022 predictions sometime next week. And then we'll be back in the new year. So happy new year to everyone. Let's hope for a nice little bounce back in the digital asset market over the next couple of weeks. And we'll see you in 2022.